According to supply managers in the 9 Mid-America states, how is the economy performing?
Creighton's survey of supply managers, manufacturing supply managers in 9 Mid-America states, stretching from North Dakota and Minnesota in the north, right down the middle of the country to Oklahoma and Arkansas in the south. It was down below growth neutral, and that's certainly not good, but it's only slightly below growth neutral. July's number, this is for July, 49.4, and that's down from June's 50.7. So what's moving? The manufacturing economy is moving sideways, and there's little doubt about that. And there may be other news coming out there, but the manufacturing sector is moving sideways. And a lot of it we're seeing with imports, for example, with the president's trade policies, in my judgment, they're having a negative impact on our surveys. The import reading was down to 36.3, again, 50s growth neutral from 30 in June. The export reading, exports. Now you say, well, what do tariffs have to do with exports? Retaliation from our trading partners, and also weakness among our trading partners. 38.3 down from 43.4 in June. Now we asked the supply managers about switching from one supplier to another. Only 6.7% said they switched from international to domestic. So the idea of raising tariffs on imports to get the supply managers to buy from alternative domestically is not having an impact, much of an impact. 67% said that they're reported making no changes. In other words, it hasn't had an impact. And finally, the 26.3 indicated one international supplier to another international supplier. For example, maybe moving from China to Vietnam to Indonesia, those sorts of moves. And thus the tariffs thus far are not having the intended impact. And of course, I've been a vocal critic of tariffs, not of President Trump, but just of that policy of his. And you'll see the chart there in blue, beautiful Creighton blue, down, and as you see, down significantly from a few months earlier. And you see there in red is the national number coming out later this morning. And you see there in black, that's the rural areas of mostly the same states, and that's rural areas of mostly the same states. So the economy is cooling down, and you see my statue here, I see bull over bear, and I wish I could flip it. The bear is sort of pulling, is rearing back to the bull, so we'll see what happens there. But right now it's an even fight, the bull and the bear. In terms of manufacturing, in fact, the bear is winning in terms of manufacturing.
What were the hiring trends?
Hiring is not good. I mean, the hiring reading, new hiring, is 45.4, down from June's 49.4. So 49 to 49.4, 45.4, that's obviously not good. And if you look at the numbers, now this is from the Bureau of Labor Statistics, this part of the country has lost about almost 13,000 jobs, and that's about 0.9%, almost 1 percentage point. The U.S. economy has lost almost 90,000 or 89,000 jobs, and that's 0.7%. But if you look at the overall number, that's outside manufacturing, it's still growing. We're still seeing growth there, at least according to the BLS numbers. Now, I would issue the caveat that, can you really believe some of those numbers? Will they be revised later? And the answer is yes, they will be revised, and they probably will be revised downward.
What inflation trends are you noticing?
Inflation is also not going in the right direction. It's going up. Now, this is at the wholesale level, and one could say, well, the tariffs are beginning to have an impact on prices. Not that much, but some. The reading was 69.7, and that's down from 67.9 in June. So prices are moving a bit higher at the wholesale level, and for that matter at the consumer level. Consumer prices last month was up 0.3%. The PPI, the Producer Price Index, that's not much there, 0% over the last 5 months. And then if you look at the core though, about 3.6% for the PPI at the national level. So again, the movements are definitely in the upward direction on prices, but not as significantly as I expected and as most economists expected from the tariffs. In other words, the tariffs have yet to really kick in terms of prices, but they are having some impacts thus far. Thus far, this is, I think, very important. Very important is that the small suppliers, the small companies, I should say, are being squeezed. In other words, they can't pass it on to their customers, and they're squeezing their profit margin. Likewise, at the big companies, their profit margins are being squeezed, but they had also been pushed upward because of some AI and other positive factors. So businesses, small businesses and medium-sized businesses are being squeezed by the tariffs. They have not passed it on to their customers.
What is the economic outlook?
The outlook for manufacturing is still not good. I expect, but in terms of the Fed, for example, the Fed is met last week after we had this video. The Fed did not raise rates, and that's what was expected. They held rates the same. And of course, the president's pushing, and I have to say, the more he pushes and pushes and pushes, the stiffer Jay Powell, head of the Federal Reserve, stiffer his spine gets. Mr. President, quit pushing. He might reduce rates if you quit pushing. Now, the Fed meets again on September the 16th and 17th. That's the next meeting after this July meeting. I'm at 80% of a reduction at that point in time, but that's going to be up in the air. In other words, the economy is slowing down too much to not reduce rates. In other words, there's momentum in the negative direction to reduce rates to stimulate the economy. However, stimulating the economy stimulates inflation. So the Fed's caught between a rock and a hard place. Right now, I'd say 80% probability of a rate cut at that point, 25 basis points or 1/4%. But keep an eye on the Federal Reserve's balance sheet. Now Jay Powell can actually, he can actually take some action to reduce interest rates, not the one the president wants, which is short-term rates. And the reason the president wants short-term rates lower is because the federal deficit is being raised, of course, and he wants to fund that deficit without increased interest costs, which of course is not something he wants to see. What's the balance sheet? The Federal Reserve could they'll stop quantitative tightening, and I expect that to happen. In other words, keeping the balance sheet the same. So long-term interest rates would move sideways, and that's what I expect. And I expect inflation to tick up a bit in Q3, which we're in, and Q4 likewise. So that's what I expect in the inflation front. Long-term interest rates, as I indicated, probably move sideways to a bit upward. Now, what's pushing upward is inflation. What's keeping them sideways is a slower economy and the Fed moving out of quantitative tightening to just doing nothing there on long-term treasuries. And also keep an eye on the bond market, obviously. I shouldn't say obviously. Obviously for an economist. For everybody else, perhaps you say, what is the bond market? The bond market's where you see what's going to happen in the future. Stock market, not so much. Stock market, investors are just pushing, upward. Bond market, not so much. There you'll see investors bailing out what sometimes called the bond vigilantes. Now you don't hear that term used often, but when they bail out and you see rates, if rates come down, that's indicating the economy is slowing down. If rates go up, that's an indication that inflation is more of a problem. So keep an eye on that, particularly the 10-year Treasury. It's moved in such sideways for so long, you've gotten old listening to me on that about that. So anyway, the 30-year mortgage rates are likely to trend upward a bit, but not much again on that. And the Federal Reserve's balance sheets, as I said, they're probably going to stop quantitative tightening, and that's a pretty positive signal that they're not pushing long-term rates up that they were before. National ISM reading, that's ours is a regional number, theirs is a national number. That number's been coming down. Again, manufacturing is slowing down. It's not speeding up, except inflation. Inflation from that survey is ticking upward, sort of what we used to call stagflation. Keep an eye on the price of a barrel of oil, but that's probably, if it comes down, that's an indication of the slowing economy. If it ticks upward, inflation is an issue. Lately, it's been moving sort of sideways like everything else. So listen carefully to statements by the members of the FOMC, Federal Open Market Committee. They set interest rates. Ernie Goss does not set, they set short-term interest rates, I should say. Ernie Goss does not set short-term rates. If I had to set them, I would set them lower right now. I think the president's right, but he's pushing. His pushing does not help. I can say that. And I'm saying that as a human being, not an economist, that human beings don't like to be pushed in public by the president. In other words, that makes him stiffen his spine. Keep an eye on the squeeze between junk bonds, the yield there, and the 10-year Treasury. That gap between the two is too small. It should be much wider. Why is it too small? Investors don't see the risk. I see risk. They don't see it. And one could say, well, the wisdom of the crowds, they always know. Ernie Goss is one human being, or an economist perhaps. They are investors globally, and they say risk or not that much. I say the risks are greater. Also, first-time claims for unemployment insurance. That's the most contemporaneous measure of what's going on in the labor market. Every Thursday except holidays such as Thanksgiving, their first-time claims for unemployment insurance and continuing claims. That's the biggie. Keep an eye. I shouldn't say the biggie. That's the most forward-looking. Well, I guess contemporaneous, not forward-looking. It's more contemporaneous, but it's telling you something that others are not out there telling you right away. So keep an eye on that one. But that's it for our first day of August. Reporting for the month of July, we had, it was not bad, but certainly not good. And the manufacturing sector is slowing down with job losses continuing. And that's it for the month. We'll see you again the first business day of September. Until then, may your economic cup runneth over. This is Ernie Goss with Creighton University, and thank you for joining in. Bye.